Politicians, economists, and market experts argued vociferously about whether or not the U.S. economy was in a recession in the summer of 2022. Politics always played a role in the debate, which ultimately boiled down to your definition of a recession. The United States entered a recession in the summer of 2022, as determined by the general definition of recession, which is 2 consecutive quarters of negative gross domestic product, GDP. The video is going to be very interesting, so make sure you stick to the end. Before we continue to our video, make sure to smash the like button, subscribe to our channel, and hit the bell icon to never miss any of our future uploads. Now let's get started. The National Bureau of Economic Research, NBER, which establishes U.S. business cycles, holds a different perspective. We were not in a recession in the summer of 2022, as defined by the NBER as a major drop in economic activity that is widespread across the economy and lasts longer than a few months. Tim Holland, Chief Investment Officer at Orion Advisor Solutions, stated, "We have a hard time believing the economy is in recession today, given a solid job market and corporate earnings growth. We also remind ourselves that recessions are rare because they have affected our economy only 8% of the time over the last 30 years. A recession, though, could yet happen at some point soon." The Federal Reserve is committed to raising interest rates until the sky-high levels of inflation begin to decline. Due to that, the economy might contract, making it impossible for anyone to contest a recession, much less the NBER. When was the last recession? The NBER estimates that the most recent recession took place between February 2020 and April 2020, because some state governments loosened regulations, unprecedented direct payouts, and unemployment insurance helped consumers get by. The economy was already growing again by May 2020. Prior to that, the Great Recession, which ran from December 2007 to June 2009, marked a previous contraction of the economy. That recession lasted longer, even though it wasn't as bad as the COVID recession. The Great Recession and the current recession were separated by the longest business expansion in American history, dating back to 1854. Wall Street says a recession is coming. Consumers say it's already here. On Wall Street, there are increasing cries for a recession, but for many of the households and companies that make up the global economy, the downturn has already begun. When people look at their budgets, the first thing they cut is self-care. I've seen my clients go from having weekly appointments to bi-weekly, and my bi-weekly clients are now coming in every 6 weeks, Palmer said. Consider Gina Palmer, who manages the popular She Salon on Atlanta's North Side Drive to the west of the city center. On a Friday morning, she would typically anticipate the bustle of customers in her store. But aside from a few employees on that day late last month, it was otherwise silent and vacant. Her customers worried about paying for summer programs for their children despite rising food and gas prices as summer break gets underway. NBER definition of recession. The NBER is not prepared to declare that the current economic upswing is finished despite poor economic events this year. That is entirely fair, despite the fact that the GDP has decreased for 2 consecutive quarters as businesses continue to hire new employees at a remarkable rate. The labor market stands out as a clear anomaly because the NBER is expecting a significant decline in economic activity across the whole economy, not just in a few specific sectors. The drop typically is to extend longer than a few months as well. Of course, the recent COVID recession, which lasted only 2 months, was a notable exception. However, because of how severe and pervasive that downturn was, the NBER had to be liberal in how it defined certain terms. However, in general, the NBER will wait until all 3 of its requirements for the decline depth, diffusion, and duration have been satisfied before issuing a determination. Recession odds. More than 70% of adults believe the U.S. will be in a recession by year-end. There's also concern in the markets, where the Stoxx Europe 600 is down almost 19% and the S&P 500 has fallen more than 20% from its high in January. There's a danger that a recession will become a self-fulfilling prophecy, where consumers and businesses will buckle down and reduce spending as a result of the near-constant flood of warnings and depressing headlines that would drain the economy of demand, worsening any slump. The risk of a self-fulfilling recession, and one that can happen as soon as early next year, is higher than before. Even though household and business balance sheets are strong, worries about the future could cause consumers to pull back, which in turn would lead businesses to hire and invest less, Anna Wong said. Danny Blanchflower, a professor of economics at Dartmouth College and a former BOE policymaker, co-authored a paper in 2021 that claimed declines in U.S. consumer expectations gauges of 10 points or more, as reported by surveys from the University of Michigan or Conference Board, or predictors of recessions, dating back to the 1980s. This year, the Conference Board index has decreased by over 30 points. Metrics NBER consider for recessions. The NBER is evasive about the precise economic indicators it uses because it needs some leeway in predicting recessions. Real personal income less transfers, PILT and on-farm payroll employment, real personal consumption expenditures, wholesale retail sales adjusted for price changes, employment as determined by the household survey, and industrial production are among the factors it typically takes into account, according to the organization's website. However, it does not give every indicator a specific weight. According to the NBER, a recession is a shift in the economic activity. A mix of art and science goes into figuring out how and when that transition happens. Several economic factors point to a less severe recession. Beyond historical trends, several economic factors point to a less severe recession, should one come to pass. 1. The housing and auto industries are strong. While inventories are low and likely drop much lower with increasing borrowing rates, housing prices have been high and resilient. Due to a lack of semiconductors, production rates for automobiles are lower than at earlier peaks. Order backlogs might maintain manufacturing activity unusually high for a recession as supply networks clear. 2. Labor market dynamics remain robust. In addition to being tight as measured by unemployment rates, the labor market is also showing record high ratios of fresh job vacancies to prospective employees. This shows that businesses would decide to lower their open job advertising first, possibly postponing the impact on unemployment rather than firing current employees. 3. Balance sheets are in the best shape in decades. Banking sheets are in the best shape in decades across businesses, homes, and the banking industry. Furthermore, given present demands for energy infrastructure, automation, and national security that are not directly related to the business cycle or the Fed's activities, drivers for corporate capital investment remain robust. 4. Corporate revenues may be more durable. As more businesses develop subscription and fee-based business models, the earnings share attributable to recurring revenue sources is increasing, as seen in the composition of the stock index today. Ugly inflation numbers make a recession more likely in 2022. Recent economic estimates suggest that when inflation rises further, the likelihood of a recession rises as well. As a result, there may soon be more layoffs, fewer jobs, and higher interest rates. Banks originally forecasted a slowdown in 2023, including Citigroup, Deloitte, and PNC Financial Services, but recent predictions suggest a recession may happen in 2022 or earlier in 2023 than previously thought. Latter week, Bank of America predicted a moderate recession for the last few months of 2022, echoing an earlier prediction by the Japanese investment bank Nomura. The outlook represents a change from past projections, which only indicated a slowing of economic growth. In a similar vein, Wells Fargo has revised its forecast for the first quarter of 2023 from a soft landing to a moderate recession. According to Wells Fargo's chief economist, Jay Bryson, May and June inflation data from a variety of sources, including the monthly CPI report, played a significant role in the altered projection. He notes that inflation is getting more entrenched and more pervasive and labels the June CPI data ugly. Rate increases can reduce inflation by raising the cost of borrowing money for individuals and companies. Hope you guys enjoyed our video. Make sure to subscribe to our channel and hit the bell icon for more videos. Thanks for watching and have a wonderful day.